Good afternoon, and thank you all for joining us. We're just going to wait one more minute for a few more people to log in, and we're going to start our exciting series, session number 4, focus on the general expenses, net profit, and the income statement. And again, thank you for joining us for the Financial Statements 101, Mastering Financial Statements webinar series for small business owners. Today's going to be a very exciting day because we're going to go over effectively your whole profit and loss today. For those who have joined our prior webinars, they'll be up to speed a little bit more. For those of you that are new, we are going to do a quick refresh on information that we've already kind of shared and where we've got to. We'll go over the past information fairly quickly though. So if you are new and this is one of your first webinars that you're attending, feel free to really focus in quickly on what's going on. At the end of the session, we have questions and answers. Feel free to jot down any questions that you might have during the presentations. There's a lot of information here, but we'll do the best we can to answer the questions that we have at the end of the presentation. Perfect. So today, I'm hosting the webinar series and I'm presenting the webinar series because of the rest of our team's schedules and so forth. So you have me for everything on this side, and Anna is also helping us in coordinating the session. But on that note, it's now 3:03 and let's begin our presentation. Thank you very much again for attending. All right, so a little bit about myself. I'm a very seasoned CFO, COO, and CEO of many companies over the past 30 years. Effectively, my job is to help grow businesses. That's what my passion is. I do that by analyzing numbers, and I like to make sure the numbers make sense before we analyze them. But really, that's what we're trying to do, is we're trying to increase the value of your business. You're all here because you want to be better business people. We're trying to grow your profits. We're doing that together, and by growing your profits, you're growing your business's valuation. So that's my job here today, is to help you all understand your financial statements, how to read them better, and how to add value to your organization and make better informed decisions. Perfect. So our mission at Ceteris, is to help small business owners meet their business objectives by providing timely, accurate monthly financial statements to help business owners better understand what's going on in their business. And the learning points for today's webinar are the following. We're going to be going over a recap of many different things from prior sessions because we're trying to tie that information together to what we're going over today. The focus is on revenue, cost of sales, your gross profit using different accounting methods that we've covered in more detail in session 3 and 2, but we're going to do that. Then we're going to add to it to talk about the fixed costs, your variable costs, your operating costs, your chart of accounts, how defining that. And then we're going to do the most important thing, which is analyze your net income. And one of my favorite key performance indicators, which is your break-even analysis. Break-even analysis is a number that you should just have at the top of your head all the time. You should be monitoring it every month to see what's going on. Perfect. So let's talk about the recap of our prior sessions. So one of the things we learned in our past sessions is that your profit and loss statements are different based on the different ways that you're choosing to do your accounting. Are you using a cash method? Are you using the accrual method? Are you using something in the middle like a modified accrual or cash method? What does that do to your financial statements? What does that do to your profit and loss? And what are the limitations and strength of each one of these? Let's go over that quickly here right now. So in terms of the recap of the basic financial statements, why do we have financial statements and what are the basic statements? So your basic statements is your income statement. It shows you how much you made, how much you spent, and what was left over for your profit. Your balance sheet. It shows you what you own and what you owe and what the difference is. So what you own less what you owe, the difference is your equity, And your statement of cash flow. Now, your statement of cash flow is important for people who are doing accrual methods and so forth, because Your statement of cash flow is just explaining what happened to your cash. How did you make cash? How did you spend cash? Perfect. So the basic monthly, why do these statements even exist? And the first answer to that is to help the owners make better decisions, to help them evaluate what's going on. Okay, once you've evaluated what goes on, you make better decisions. Okay, and another reason why we do financial statements, a lot of people think this is the first reason we do it, and really it's the last reason we do it, but is to maintain partner relationships or compliance requirements. So that might be your banks, your landlords, other owners, and so forth. So to me, and the government, of course. So to me, that should be the last reason why you do your financials, not the first reason. Perfect. So let's talk about it. This is your income statement. Okay. So this important statement really exists to show you how much your business made, which is your revenue classification in the top quarter of the page. Okay. How much your business spent, called your expenses. Now that's the bottom 2/3 of the page. Okay. The difference is called your business profit, okay, which is at the end. And there's different classifications of business profit. We're going to talk about that towards the end of the session. But effectively, the formula is really simple. Profit equals your revenue less your expense. But that formula gets complicated based on what accounting method you're using. So we talked about cash basis, accrual basis, and modified accrual. So let's see how that impacts the different types of financials. Okay, if you're reporting on the cash basis, what's going on? Well, revenue is recognized when you receive your money, not when you've actually provided the service or done it. It's when it comes in and when it becomes cash. Well, there's challenges for that. That challenges also have to do with, your revenue from your membership fees in this case, which is the top line revenue. Okay. Are those annual fees that you're collecting and you're just reporting all the cash if they're paying up front? Okay. So that really is a function of how much of annual fees you've collected. You're not really reporting it correctly over time, just what's your instant sales. Okay. Cross classes, okay, same thing. Are they prepaying for 5 months of cross classes or 5 sessions and 0 have started? Well, we're still calling that revenue if the cash came in. Okay, events is your third line. So are those events that are to happen in the future, or are they events that are happening during that month of September 2024? Well, as a result of people paying you when you're kind of doing your snap sales, not when you're providing the services, we don't really, comparing revenue periods doesn't really tell us what's really going on from an organizational point of view. It's just kind of showing us what our collection efforts are, okay? And we're comparing collection efforts month over month as opposed to what our true sales are. Well, expenses work the same kind of way. Okay, if you paid it during the month, it counts, and now we're reporting. And if you didn't pay it during the month, even if you owe it, it doesn't count. So that can be a little bit confusing. Now, if you're paying everything every month, the way a lot of business people does, it's a little less confusing. But the essence of that is that if you tend to collect more money, sometimes people will pay some expenses that were actually incurred in different periods, so they're going to catch up. So even though you've collected more money, now your expenses are higher and your profit is lower. And it really is a function of the fact that you just paid off a whole bunch of expenses that were compressed. So, things like your payroll, was there 2 or 3 payroll periods inside there? If there was 3 payroll periods in that month, okay, and you're just reporting it on the cash base, you're going to see that your payroll is 50% higher than normal. With your rent, for example, was there a deposit paid, or was there an annual amount? Maybe it was a CAM catch up or something like that. Well, it's going to hit it that month, and now it's going to skew your information there. All right. If you're buying computers and stuff like that, we're tending to expend them, and we're not showing the life bound. But expenses, again, are a function of what's paid. Okay. And profits represent the actual revenues, okay? But are your actual revenues overstated or understated? Are your actual expenses overstated or understated? And is your profit overstated or understated? And what does that do to your valuation when you go to try to sell your business or buy another one or go get financing? So it's difficult to make corrective actions under this circumstance. Realistically, you're probably using the cash basis to report to the government or to other agencies. You're not really using it as a great tool to manage your business. All right. So let's talk about a profit and loss basis under the under this. Sorry, this looks like it's a little bit on the duplicated side, so I'm just going to move past this slide here. But let's talk about the accrual basis. Okay, accrual revenue is recognized when it's earned. Okay, not when you've collected the money. Okay, so now you have accounts receivable and accounts payable for your expenses for when it's done. But additional work, okay, is required to do accrual. It's tougher to do than the cash basis. The cash basis is kind of simple accounting because you're just working off the bank statement and you've got it all figured out. Well, on the accrual basis, you're working off of your invoices, not your cash, and you're reconciling things. So there's extra work, and extra work sometimes costs a little more money. There's more analysis. There's more maintenance on your accounts receivable. And revenue is now representative of what was earned, not what was received. Okay. Expenses, the rule for expenses is that they should be matching the revenue period or the revenue that was attributed to the expense. And additional work is on that because sometimes now you're maintaining inventories, you're maintaining accounts payables, assets, and other things of that. So expenses now represent what was incurred, and profits are really more representative of the activity. This kind of profit and loss under accrual or a modified accrual, which is really close to an accrual, okay, is going to be very helpful for helping us run our business better. We're going to understand things much more clear, okay? So meaningful comparisons, more accurate valuations, and you can optimize the business using better information. All right. Okay. So the profit and loss under the accrual, it really shows again when it was done, the variable costs. Okay. Variable costs are your costs of sales. Okay. Reported when the sale is made. So again, this is part of your matching principle. Your gross profit, again, is your revenue less your costs. Gross profit is a function of what was sold and the direct costs related to the sale. Your financial statements are accurate and representative. Your fixed expenses, which we're going to go into over more detail this session, okay, later this session, is going to be reported to show the money that you actually generate. Your net profit is your gross profit less your operating. So your gross profit is in the middle of the page. Your total operating costs are at the bottom, and your net income is at the very last line. Perfect. Modified accrual, I'm going to go over this very fast, but effectively it's a combination of the two. But typically on modified accrual, they're recognizing revenue when it was earned. It's more accurate, again, requires some more expenses. Okay, some recognize the matching principle. Inventory may be maintained for cost of goods sold. Some maintenance around AP. Assets are expensed. Okay, many expenses are coded to the period that they're paid. So profits are generally a lot closer and more accurate, okay, than the cash basis, but not quite where the accrual are. I would say there's still good value in using a modified accrual to understand what the business is doing. Okay, it's more comparable. All right, perfect. So moving on, let's define your revenue, your variable costs of sales, your fixed operating costs, and other costs. Part of this we also went over in session 3. So I'll go over that portion, which is the top portion, a little bit quicker, and then we're going to go into more depth into the bottom portion. Great. So let's define your revenue streams. Okay, so for this fitness club, we have 3 buckets of revenue: membership, packages, and product sales. Okay, defining how you track the different sales streams into those subcategories is important. This is done when you build your chart of accounts. The chart of accounts is often built with the accountant, but it should have the input of the owners or of a larger organization that's involved to help understand the tracking of things that are really important. Okay. I also like to break this out when I understand if there's different variable costs behind the memberships, behind the packaging and specialty classes and so forth. So for example, the specialty classes may have more labor, such as class instructors, okay, which doesn't really attribute itself to the membership. So now I have a little better understanding of my gross profit by revenue stream, not just as an entity there. It's a little extra work that I do, but it helps me understand what's going with each section. Why is that important? Because I want to emphasize each revenue section that's generating more money. I want to put more resources behind it to juice it up to create more gross profit. On the margin stuff that are slow, I might ask myself, do I need to raise prices? Do we consider just a loss leader? Is it there to try to do other things, in other words? Okay. Or is there something else we should do? Maybe drop that line or change it somehow to get more money. Okay. So effectively, this is important. Okay. I like to segregate these things when I want to understand its growth over time as well. So that is also important. We're going to show you a good example of that towards the end of the seminar. So lastly, I don't like having buckets where it's not really helping me make better business decisions. Okay. I'm fine having a lot of accounts as long as they're what's called a sub account. They roll up into the more senior things that are important for me making decisions. I'll show you an example of a roll up of accounts as well as we're moving on. All right, let's define your business expenses. Okay, now when I'm talking about defining it, I'm talking about the categories. Okay, now these categories of business expenses are super important in analyzing your business's performance. For example, at the end of this session, we're going to talk about the break-even analysis. Break-even analysis works because we've segregated variable costs from fixed costs. Okay, doesn't work so well if we treat every expense the same. So we do this, we segregate this to get a clearer understanding. And the basic categories are your cost of sales, cost of goods sold, depending on what your business you're in. Those are supposed to be heavy variable costs. What's a variable cost? When you sell one more unit, okay, there should be an associated cost movement in your cost of sales, a variable cost movement. They should be going like this as your sales fluctuate. Okay, perfect. Okay, the objective of the cost of goods sold or your cost of sales is to figure out what your gross profit is. Okay, fixed operating costs. So these are the general costs. The hallmark one is your rent. Your rent doesn't care how much you sell or how much you don't sell in 98% of all leases. Sometimes they have overrides, but 98% of all leases, it's the fixed amount every month. That's a perfect example. We categorize those as your general operating expenses. All right, perfect. That helps us understand your operating profit. Now, your operating profit is one category below your net profit. Your operating profit is your operating profit from operations, but we have other expenses that just come out of the blue, okay, that really don't have to do with operations, okay? So for example, if there was a lawsuit, okay, and there was a settlement or lawyer's fees or something that's a complete anomaly to the normal operating, that can go into your other expenses, exchange losses, things that aren't part of your routine costs. However, that's used to understand net profit. Okay, so let's talk about your cost of sales. In our example, that we talked about, variable costs increase on the incremental sales, as we've discussed, and your accountant is also helping you understand what those categories of cost of goods sold are, okay? Or if you're part of a larger group of companies, sometimes it's, you know, the master franchisor who's kind of laying down those chart of accounts, that kind of classification. But the key considerations in defining those costs, again, is, you know, does it have a different variable cost structure behind it? So if so, maybe we do. So in this case, the pharmacy cost of goods versus the over-the-counter cost of goods sold have completely different costs associated behind them. And then we're also figuring out what the rebates are. How material is it? If these are just a couple of dollars a month, I don't want to see them on my condensed financial statements. Okay. Is tracking this an important aspect of the long-term growth? Well, yes. We want to know if our over-the-counter costs, okay, change versus our over-the-counter sales, okay, that OTC thing. Do I want to compare this against a specific revenue item over time? Yes, okay. So measuring gross profit. So again, gross profit is just the difference between the two, but gross profit can be done your total revenue, your total cost of sales, or it can be done by the streams sometimes. A bit more work is done, but that work also tells me what those streams are doing. All right, perfect. So when we measure gross profit, we measure and understand the following: how changes in sales impact our gross profitability. Okay, how changes in direct costs impact gross profitability. So a change in sales is going to change our gross profit. A change in direct costs, if they're increasing, is going to decrease our gross profit. We're also measuring the combined effect of those two because they're not staying still every month. They're moving together, okay? And the combined effect is also being hit by our gross margin. So gross profit is a key aspect of your profit and loss statement, and that should be analyzed every month on itself. I like to analyze the revenue every month by itself, each of the streams every month by themselves, each of the cost of sales categories by themselves, the gross profit by itself, which is the cumulative effect of the top two, the revenue and the cost of sales. Okay. We'll talk about how to analyze those monthly in a few later slides. Let's talk about defining your fixed costs. Fixed costs are the operating costs that tend to remain constant regardless of the activity level of sales. Okay. Grouping similar fixed costs under common categories allows a clearer understanding of them. Common categories. So again, categories and then subcategories. Okay. I like to do a lot of my analysis at the category level so I see the whole picture. And if I see a problem at the category level, I like to expand that category level and look at what's making up that category to see what's changed. Okay, but the common categories, okay, are your rent and occupancy costs, your advertising costs, bank fees, okay, employee benefits and related costs. I like putting management fees here. I don't like sticking my management fees in my variable costs. Management fees can sometimes be discretionary. I realize owners often work in the businesses, but the question becomes, is it a fair market value consideration? And what I tend to think is your management fee or the management is paid is really, it's really not related to each incremental sale. It tends to behave more as a fixed sale. So I like to put that either in the fixed costs, or if it really is highly discretionary or a portion of it is, I like to put it in other expense, even below my operating profit. And when I do that, I get a nice clean picture, because what can happen is if I have a banner month, the manager owners can say, well, I'm going to take out extra money. That extra money is now buried in your fixed cost and your operating profit has gone down. It's not showing me accurately what's going on. So there's nothing wrong with subdividing and go, look, as a manager, I'm going to pay myself $5,000 a month, but we had a great month. So I'm going to give myself an extra five, but that extra five is going to go under the operating expense line and into the other expense category. And therefore it's not going to pollute what my true net income was from operations. All right. Professional fees, that's often a category: insurance, okay, and other general costs. Some of these are sometimes grouped together as general and operating costs, but generally these are the main kinds of categories we typically see. So your fixed operating costs, they tend to be less flexible, less variable, and have commitments behind them. Okay, that's what's behind them. If you're buying extra lettuce or tomatoes or meat to sell, there isn't a commitment. You don't have to go back to your vendor and do that, but your rent has a commitment behind it. Your insurance has a commitment behind it. Okay, your management typically has a commitment behind it. So that's another way to help understand where does it belong. Again, this is done with your accountant, but you also have input with your accountant as well. Okay, and you can always seek guidance as well for to help understand better classifications from us. But considerations in defining expense sub-accounts, okay, does this amount remain constant every month? How material is this amount every month? Will it help me make a better decision? Like, you know, guys, I often see parking as a standalone item. It shouldn't be, okay? It should be under vehicle expenses or general or something. It's not really going to make us make better decisions in our business to know what the parking fees are unless they're really a huge amount. Okay, but that's an example of a sub account that should roll up under either automobile or general. Okay, is tracking this an important aspect of the long-term growth and sustainability evaluation of the business? So, definitely, I like to have insurance line item because that sucker can move pretty dramatically, and I'd like to see how it behaves over time. Um, do I want to compare this against specific revenue streams over time? So, for example, maybe, we're marketing those extra classes in the fitness center and we're going heavy. Okay, well, then I might make underneath my marketing or advertising, I might make a fitness class marketing so I understand what my cost of acquisition was for that stream. So think about this thing from a logical point of view. Reach out when you need help in determining that. But that's the kind of stuff you want to be paying attention to. So measuring operating profit. So operating profit, we have our sales, we have our cost of sales, we have our gross profit, we have our operating expense, then we have our operating profit, okay? Also known as earnings before, okay, income and taxes, okay? So provides a better understanding of the operational efficiency. That's what we're doing when we're analyzing operating profits. How well are we operating the business? Okay. That's yet another reason why I like to take management bonuses and put it below the line because I don't want to skew how well we're running the business. Okay. When we measure operating profit, we're measuring our core profitability from our business operations. Okay, how efficient is the business running? What's management's operational efficiency of the business? Okay. I also like to focus when I'm helping companies get to the sell or the business transition and evaluation or banking or things like that. I like to draw whoever the audience is, I like to draw their attention heavily to the operating profit. Okay. Let's take the discretionary odd things out of the equation that are in net income and let's focus on that operation. So I like making the valuations of your business more on normal operations. So operating profits really show you your business trajectory over time, the sustainable, how well the cost management is, and how well it's behaving against its peers. Okay. If you're taking out large bonuses and it's part of your fixed costs or it's part of your cost of sales as management, okay, and now you're trying to compare your business to another business or the business valuators trying to help you get your business ready for sale, okay, and this is inside there, this really muddies the water, okay, and it makes it hard for people to understand what's going on, okay. They don't know if your costs have gone up because you hired another staff. They just don't know sometimes. Okay. So defining the other expenses. So after your operating profit follows your other expenses, and you'll see a graphic of all of this here in a minute. But costs are not tied to the core operations of the business. So this often includes non-operating costs, discretionary management costs, and other irregular costs. Okay, so categories for this could be management bonuses. I like to put them there. Okay, other costs, other revenue, other costs, discretionary expenses. So meals and entertainment. Sometimes if you're getting a lot of perks in your business and you're running it through, I know you're trying to reduce your taxes, and that's all fine. Reduce your taxes. But if this is a discretionary expense, okay, then I want it below your operating profit. Okay. It can live between your operating profit and your net profit. So there's an easy add back, an easy clarification of what's going on. Ownership bonuses, okay, losses on the sale of assets, legal fees that are not typical, restructuring costs for your business, gains and loss from investments that you may have that are not part of your core business. All of this stuff belongs below the line, okay? Corporate taxes, okay, and so on. So your other expense, okay, so does it remain relatively constant? How material is it? In this case, it shouldn't be constant, everyone. Okay, your other expenses should be anomalies. Okay, they should be. Now, look, if you're hitting great numbers all the time and you're bonusing yourself out the same amount every month, it can still live here. Okay, but other than that, they should be more anomalies. Okay, Is tracking important? Again, I don't like seeing my financials cluttered with a whole bunch of information. I'm fine with that as long as it's condensed up and we're analyzing, the condensed version. And then when we have questions, we've got all the detail inside there. Okay. Do I want to compare this over time? Absolutely. Okay. And measuring net profit. Again, now we're at the bottom. Okay. We're measuring the net profit. So what it really does net profit do? Well, it really explains your total entity's profitability. It doesn't necessarily represent your routine operation profits. So that's important to understand. Everyone thinks that net profit is the Bible. Well, it is the Bible to a degree in terms of understanding, what your true profitability after all your expenses are. But we do need to figure out on those other expense categories what doesn't really belong there and what does. Okay. So we measure net profit, we understand total profitability, the cumulative effects of everything are understood when we're looking at the net profit valuation, can also be based on total profitability. Okay. Now, typically buyers want to buy on your net profit. Sellers, in my experience, would rather sell more on operating profits. Okay. So, but if you haven't segregated it out and it's buried in there, then the debate doesn't even exist. Okay. Net profit shows business total profitability over time. Okay, here we have a full example of everything we've talked about. And what we want to do is try to tie this all together. All right. So one of the first things we're tying together in this example is the following. Okay, so what we did is we've got 4 revenue items. We've got our in-store sales. Okay, this is a fast food store. We've got our delivery sales. We've got parties and functions. And then we got our discounts and other charges, which I just lumped together. Okay, now there's more detail usually in this, but I just lump it together for quick analysis because I like to look at one page to say what the heck happened. And then when I get questions to myself or from other owners or whatever, then I like to drill into all the fine details. So I like having all the fine details, but I like to have a clean snapshot of what's going on as well. All right, so what we did is my first numbers beside every month, you're going to see a whole bunch of percentages. What is that? That's the percentage of sales that generated. And what we're going to see in May versus June, when we look at our in-store sales, we're going to say that's a $10,000 jump. And in our total revenue, we had a $10,000 jump. And when we look at our delivery sales in May, June, and July, we see that is exceptionally consistent. 20,000, 21,000, 22,000. Look, it's moving in the right direction, but it's relatively consistent. However, when we look at our in-store sales, something happened in May, okay, where we were 10,000 short. What happened? Okay, so that's important to go. Was there 5 weekends in June and only 4 weekends in May? Okay, was there a marketing program that jumped up the sales in June? Well, see, this is important. And now that we have the segregation, we can ask the right questions. All right. What's happening with our cost of sales? Okay. Well, cost of goods sold, I don't like seeing a 4% move month over month. Okay. Because that's a 4% loss on your bottom line. Okay. And it also is showing something with the efficiencies. But I don't know what's causing that 4%. But if I'm analyzing, I'm saying, okay, I know that my sales increased quite nice month over month, but my bread costs remain relatively consistent. Now, guys, I'm assuming that this is using an accrual or a modified accrual method, okay, where they're tracking inventory. If they're not tracking inventory, this might just be a function of how they're actually paying their bills, okay, not what was actually used. So hopefully that makes sense. Okay. Our food, well, I'm seeing the basic food costs or the meat costs. I'm seeing that kind of staying consistent. It is interesting, okay, that we had a slight decrease in sales in July, okay, yet we had an increase in our food. Now, is that something from our suppliers? Did something go up high in price? Okay, well, maybe it's important to know. Was it the cost of cheese that changed? Was it the meats? Was it the chicken? Was it the tomatoes? Those kinds of things. Yeah, I've lived it all. They can move dramatically and they can change our costs. And then if we're not conscious about it, we can do things differently as well too. Okay. Sides, again, that behavior was a little bit off, but at the end of the day, our total cost of goods sold is 32,2820. Our cost of, well, let's just assume this is direct labor. In this example is 29,2525. So part of the reason why it's so high in May is because there's probably a portion of this labor that belongs under fixed costs that isn't. That's what my guess is. Number one. Number two is labor doesn't really change exactly with your sales. It kind of moves in steps. Okay. So you gain efficiencies at a certain level. For example, maybe one staff can handle 100 customers a day, two staff can handle 200, three can handle 300. Well, if you had three staff and you were doing 250 at 250 customers a day in May, and you were doing three staff in June and you were doing 300 customers a day, that's going to drop that percentage. Okay. Just there's limitations in everything. So you've got to apply logic to everything you're doing. Okay. But our gross profit kind of changed dramatically. Okay. Over the periods. Obviously, June and July are kind of hero-ish, and May wasn't so hero. Okay. Our rent and occupancy. Okay. Well, that kind of moved kind of funny. Okay. What happened? Did we actually, what happened? Did we renegotiate the lease? Our advertising went up, but it went up kind of steady. Our direct operating costs, they went surprisingly down in July. It's all of these things that we can look at. But what do we see? We see our net income at 5%, net operating at income at 5%, but our net income at 3%. Then we have 14 and 13 and 12 versus 10. And you see, we're understanding what, with this level of segregation and this level of analysis, we know what's really affecting our 5%. Our 5%, okay, is a function of our rent cost, which was lower, which helped us, and horrible margins, okay, because our sales were shot, and in specific, our in-store sales. This is the kind of help that's going on, okay, when we're analyzing and doing it. So revenue, segregated by nature. Costs, let's keep them by major category. Direct labor as part of variable costs. Gross profit, okay, let's analyze the gross profit. Let's analyze the fixed costs, okay, by major category. And when we have questions, we can drill into them. Let's figure out our net operating income. Again, that's my favorite line to understand what's going on with valuation. And then let's understand what our other expenses are. Why did they happen? What can we do to mitigate them? And then finally, how's our net income? Great, good stuff. All right, now that we've done some net income analysis, we can talk a little bit more about our break-even analysis, and we're coming down the home stretch. Good. So again, analyzing your revenue. Sometimes it's easier when you just analyze it in small portions, but this is best done through comparison and analysis. My three favorite comparison periods is this month over last month. That's kind of what we're doing. Okay, this month, okay, this year to the same month last year. So I would be comparing, in this case, let's just say July 24 to July 23. I want to see snapshots in time 1 year later. What the heck are we doing? Okay. This month, year to date, compared to last month. So give me all the sales revenue up to July 24, and let me compare all the sales revenue from July 23 from January 1. Okay. That just tells me how I'm doing year over year to date, and I like those kinds of analysis. Comparing the different periods gives me different perspectives to look at something, so I really understand the dimension of it better. I understand where the challenges are, where the opportunities, and where the threats are. Okay, perfect. Let's talk about analyzing gross profit. Again, now that I've analyzed my revenue, I can start looking at my cost of sales and my gross profit. Okay, so again, when I can, in this case, it's a little bit trickier too, but, sometimes I like to understand what's the cost of sales on my delivery, what's the cost of sales in my in-shop, because I'm getting a blend here, okay? That depends on my POS system functionality, depends on a lot of other things, but where I can, I like to segregate it. I like to know what's going on. All right, perfect. So again, where we're looking at corrective actions, do I have to look at correcting my costs? Do I need a new food supplier, or do I need to raise my prices again? Okay, analyzing gross profit margins. Okay, so gross profit is the absolute dollars. So at the bottom, we're seeing 23,895. That's our gross profit. 38% is our margins. Okay, 47% is our margins in June, and 46% is our margins in July. What are the movements like month over month? What's going on? Okay, again, movements year to date over prior year to date. I like to do this analysis on each of the different financials, movements last month over the period last month, and identify those changes over time. Those corrective actions, such as increasing and reducing costs on various streams, that's how you optimize your gross profit. You optimize your gross profit. What you're doing is you're lowering your break-even level. Your break-even level then is going to contribute a lot more money to your profit, okay? This is about really optimizing your business's efficiency, okay? Analyzing your operating profit. Okay, so operating profit again is after our fixed expenses, okay? So it's telling us now what expenses we should be investigated, corrective actions, analyzing operating on a month. Again, let's look month over month, year to date versus year to date last year. Okay, month over the same period, and identify the changes line by line. Compare these guys up to each other. What's going on and why? Oh, we hired an extra staff. We gave these people raises. What's going on? Why? Okay. Analyzing net profit, like I said, net profit in this case is at the very bottom line here. You see how the net profit is just fluctuating all over the place in this business. Okay. When you're just looking at your bottom line and you're just looking at things and you're not analyzing all the components above in a meaningful way, okay, then you can't optimize your business efficiently. It's harder. You're guessing more. You're shooting from the hip, okay? Perfect. But at the end of the day, what are we trying to do? We're trying to determine the cumulative effects of all of the above, okay? Great. All right, moving along, let's talk about break-even analysis. Some of you have heard it, maybe some of you have used it. It's a little bit complicated, but yet it's also very simple, okay? So what is it? It's an important financial calculation used to determine the point where your sales cover all your expenses and you're not in the hole, okay? So this point is called your break-even point and defines the amount of sales needed to break even. All right, now most people who know about the break-even point and break-even analysis, they stop there. Guys, that's the starting point, not the stopping point of your break-even analysis. All right, this point should be understood monthly, weekly, and daily, but we're going to go into exactly why. This amount should be one of your KPIs that you're looking at every month, okay? If you're doing EOS level 10 meetings, break-even needs to be in there, okay? So what are the components for your break-even analysis? Okay, well, your components are your fixed costs. So now we're starting to understand why we're organizing our chart of accounts a certain way, okay? Our contribution margin, okay, well, what's a contribution margin? Simply, it's your gross profit margin, that percent, okay, less 100%. And that tells you your contribution margin. Okay, so let's just pretend our sales were $100, our cost of sales were $50. We'd have 50% gross profit, 50% margin, okay? 50% margin, 100% less that 50% tells us our contribution margin is also 50% in this example. Now, $100 sales, $50 cost, $50 gross profit, $50 fixed expenses, zero. Our break-even point is $100. But the most important thing about the break-even is now that I've sold an extra $100, what happened? Well, if you're managing your business right, what happened was this: $200 of sales, your cost of sales is still 50%, $100. Okay. So now you're at $100 of gross profit. Your fixed costs are still supposed to be at $50. Okay. Now you have $50 of profit on $200 of sales, or 25% profit. So what your break-even analysis does and your contribution margin does is it tells you for every extra dollar, what's hitting the bottom line. How does that affect your profit for every extra dollar? Okay, so we're going to see that as an example. This is our formula. I know it sounds all complicated, right? Fixed margins over contribution margin. Again, contribution margin is just your gross profit as represented as a percent less 100. That's it. Okay. It's not rocket science, but it's really important. Okay. So let's take a look September 24 at our break-even analysis. So our fixed costs in September 24 at the very bottom, operating cost is $42,088. Perfect. You've identified that. Our gross margin is 18,000 over 72, which is 25%. Our contribution margin is going to be one less, okay, 0.257, or 100 less 25.7%. Okay, it's a 74.3%. So the break even equals the fixed cost divided by the contribution margin. That's 42,000 divided by 0.743. That equals $56,000. So guess what? The sales in September of 24 was $72,000. The break even was 56. Okay. Now, what does that mean? That means, okay, that means that 74 cents out of every dollar, your contribution margin after your break even goes right to your bottom line. Okay. Now you're understanding the incremental value of that extra sale and how that optimizes and completely changes your profitability percentage. Now, how motivated are you to get an extra dollar of sales if 74 cents of that sales goes into your pocket? Okay. My answer is you should be really motivated. Okay. You should do all you can. Okay. Now, again, that's assuming you've covered your fixed costs, you beat your break-even point, and you've made an extra dollar. Now, I like to say I like to analyze this. So the break-even analysis, okay, monthly sales 56, daily sales based on 30 days open. Now I've broken it down. A daily break-even, assuming this fitness club is open every day out of the month, which most are, is $1,848 a day is our break-even target thing. Okay. So every dollar past that gives me 74 cents of profit right to the business. Break even in September 23. I like to analyze that too. So I'm analyzing it and I see a higher dollar amount. Now we needed more sales to break even in September 23 than we did in September 24. So we're improving as a company. Okay. Okay. And we had 74.3% versus 72.9% in 23. So now our company is richer. By the way, companies with higher contribution margins, better break-even numbers, they're valued more when it comes to sell as well. Okay. So just thinking that, you know, your value of your business is simply a function of your bottom line times a multiple isn't true. The more efficient your business is, you're going to get an extra kick. Okay. The less efficient your business is, you're going to get penalized. Okay. Perfect. All right. We've come to that wonderful point where we are looking for questions, some feedback from the audience. Anna, I'm going to ask you to help me out where possible. I'd love some feedback. Please let us know how your session was, what your questions are, how you liked it. Thank you.
Yes, Tony, we do have a couple of questions here already for you. One of them is, what are typical ways to evaluate the value of a business, like your retail store example, in determining a sales price?
Yeah, perfect. So first of all, this changes completely based on your industry, based on everything. But it's not just your industry that defines it. So what do most people like? They like a multiple of your EBITDA. Your EBITDA is actually getting a lot closer to your operating profit than it is your net income. Okay. So that's one of the reasons why I like to work off the operating profit. However, if your business is more efficient than, let's say you had two businesses, two fast food restaurants, one here, one there, but the other one has a whole different efficiency metric. You wouldn't sell those businesses using the same valuation metric. You would say, not just because there might be a higher profits, but now this is what changes. So your EBITDA times the multiple. Now, they like to negotiate what your EBITDA truly is. They like to negotiate what the multiple is. But truly, a business is worth what the future cash flows are. Your break-even analysis and all it's analyzing when we're doing is trying to increase your future cash flow, the future profitability. Your future profitability gets more money. Okay. Great. Thank you. Great question.
Thank you, Danny. We have another one here that says, what's the difference between total net income and cash flow on a P&L statement? Is total net income basically what money was made and in the bank?
Yeah, perfect. Good. Look, a lot of times, okay, total income and cash flow. So first of all, if you're using the cash basis of reporting, okay, they're quite similar, but I'll give you an example. If you sold a car in your business, okay, now your cash just increased, but that has really nothing to do with your income, okay? If you got $50,000 ERTC loan or something like that, an injection, that just increased your cash balance, but it didn't increase your income. Now, it might be reported as other income at the very bottom. But the sale of your vehicle, you're only going to report the differential between what you bought it, sold it for, depreciated, and so forth. So only that portion, not the total sale. So the answer is under normal operating, under the cash basis, they're very similar. Under the accrual basis, it's not. Your revenue under the accrual basis is how much, okay? How much did you collect, okay? Sorry, how much did you invoice? Under the cash basis, how much did you collect? Look, you need to monitor your AR under the accrual method to make sure that you're not just making, like selling more, but you're also collecting the correct amount as well. Okay, but that's analysis of AR, and those will happen in future sessions as well. But again, very great question. Thank you for that. Good.
Those are all the questions we have, at least for now.
Excellent. Well, I'd love to thank everyone for attending. I hope that you've taken away one or two or three things. If you have, I'll consider that a success, and we look forward to see you at our next session. Please let others know, other business owner friends of yours know, other people that are interested in learning more about accounting, to join us at the seminar so we can share our knowledge with others. Thank you so much for attending, and wishing you all a blessed holiday season.
Thank you, everyone.